All right, guys, if you're just coming in, what I'm going to be going over here is just a few of my old trading techniques, how you can trade with very few indicators, very close to naked trading, but not exactly naked trading. Um, I typically, what I used to do when I first started trading is I would trade with 3 moving averages. Right now, I'm going to be using 2, but I typically would use like a short term, so anywhere from like an 8, 9, 10, really nothing over like a 12 as your short term. And then you would use like a midterm, something around like 20, 22, 25, 23, anything around kind of the 20 range, nothing really over 30. And then I would use a long term moving average, so somewhere around 50, 70, 80, 100, something like that. Um, and what you want to see is let me clarify. This was a penny stock trading strategy. So this was for scalping. This was not for long term investing. This was not for um, swing trading. This was purely for trading penny stocks at a very quick pace, on a scalping mentality, trying to get in and out of the market with 5, 10, 20, maybe 30 minutes tops. Um, this was typically done on the beginning session on the equities market, which was around 9 to 9:30 a.m. Eastern, and then I would stop trading around 11 to 11:30 a.m. Eastern. Sometimes I would take trades around the close of day, typically probably in the last hour or around the last 2 hours, but not usually. Most of my trading was done from 9:30 to 11:30, the first 2 hours of the day, because that's when you see the most volume in the penny stocks, or typically in most of the equities. But yeah, so what I would look for is you would have a scanner set up to find penny stocks that are trading on high relative volume. They have surges in volume, that they are gapping up on the beginning of the day. So anywhere between a 3% to like a 10% gap is stuff that I would look for. And by gap, I mean it would close, let's say, here on the previous day, and it would open the next day or today on a gap up. So you would have a gap in between the close of yesterday and the open of today. And typically, what that means is the pre market was very strong for that coin or that penny stock. You actually don't have gaps in coins, so just penny stocks, excuse me. Um, so you would look for anything from a 3% to a 10% gap. I didn't like trading really anything over a 10% gap because I felt like it was too extended and I already missed kind of the bulk of the move. So that's the first thing I would look for is the gap. Then I would look for high relative volume, anywhere from like 250,000 shares to 500,000 to over a million shares in volume. And I wanted that to be at least a 2.0 to a 5.0 relative volume surge. So, meaning if it was doing 500,000 in shares, if that was a 5.0 relative volume, the previous day would have only been 100,000 in shares traded. So that's how that math is done. Very, very simple. Um, so you would look for the gap, you'd look for high relative volume, and then you would look for the standard structure in your moving averages. So, like I said in the beginning of the session, you want to have at least two or three moving averages, short term, midterm, or long term. You want them to be set up in a way that is bullish. So you want the short term to be above the midterm. You want the midterm to be above the long term. So you want them to be fanned out in a bullish setup. So this would be your short term, midterm, long term. This is a bull pattern. If you are shorting, You would want it to be the opposite: short term, midterm, long term. That is bearish. So once you saw that setup, so if I saw, let's say today, let's say this is the start of the day, this would be a bullish setup. You have the short term above the long term. I have decent relative volume. You see how it's peaking above relative volume. This would be a setup that I would look to trade on my penny stocks. So how I would determine my entries is I would look for very strong bullish candles. So I would look for green candles breaking previous resistance or breaking or using previous support. And I would look for these candles engulfing or showing signs of bullish candles like a dragonfly, engulfing patterns, morning stars, anything that is considered a bullish candlestick pattern. I would look for a setup on a pullback of a short term. So you see the cross here. You see a pullback of a short term moving average. You see how it does not break this short term moving average. So, okay, this is when I would start to look to buy into my penny stock position or an altcoin position. You would look for this pullback into your short-term moving average or your midterm and long-term moving average. As long as they're below price and they are in the proper pattern, where you have the short-term, midterm, long-term, they are acting as support. So this is your support range. So if they're pulling back into your support range, you would look to buy on the break of the resistance or a strong pattern with a dragonfly or a morning star or an engulfing candle. So you would buy, or I would buy, on the break of this candle here, on this candle. My stop loss would be below the short term or the long term, depending on how far away they are. So this one would be, let's say, entered on the top here. That would give me about a 0.7% or a 1.3%. So I probably would use the long term as my support on this one, because anywhere from 1 to 2% was typically what I would use for my stop loss. So if I entered here, this would be my entry. My stop loss would be below my long term. And then I would target I would not base this was back when I first started trading. So obviously I did not base my targets on very significant levels like order blocks or anything. I would just base my targets on a percentage move up or a failure of my short-term moving average or an extremely bearish pattern. So my target would be, let's say if this is a penny stock, let's say this is $1.45. So if I entered at $1.45 and my stop loss is, say, $1.35, then my target would be $1.60 or higher, because I would look for a 1.5 to 1 risk reward or higher. I would not use significant levels as my exit. So let's say my stop loss here is 1.25, or let's just say 1% to make it easy. Let's say my stop loss would be 1%. My target would be 1.5% right there. That would be when I initially start to look to get out of my trade. If it starts to show signs of weakness, if it starts to sell off, or if it starts to hit a ceiling and looks like it can't go any higher, I will start to take profit. And then if it starts to pull back, I will close my position completely. If it does not show signs of pulling back at that level, I will just use my short-term moving average as basically my exit. And if it closes below my short-term moving average, then I will close the rest of my position. So I would enter my trade here. I would probably have closed either half or most of my position on this pullback, because that is my 1.5 to 1 profit ratio target. So once it started to pull back here, I would close most of my position, and then I would leave the rest for a close or a surge, a close below the short-term moving average or a surge up. So if it starts to get outlandish, like it's up 3%, 5%, 10%, I'm just going to take profit. I'm not going to wait for it to give me a massive sell-off for me to close that position. I was only looking for a 1.5 to 1 trade. So if it gives me a 3 to 5 to higher, I would just take profit. I might hold, say, 20% of my position or 10%, but the majority of my position, almost every single time, I would close it. So my entry would be here, initial profit here, and then I would hold the rest for a close below my short-term moving average or a very, very bearish pattern. So I probably would have closed on the break here. So somewhere around here to a break of the short-term moving average. And that would have given me, my initial position would have been 1.5 to 1.6. The rest of my position would have been closed at 4.5 or higher. Now, what you want to look for, or what I looked for when I was trading this setup, is you want to look for increasing volume as price is rising and decreasing volume as price is falling. So what we saw here, if I entered right here, then I want to see increasing volume as price is rising, which we saw here, decreasing volume as price is falling, we saw there, increasing volume as price is rising, decreasing volume as price is falling, same thing, increasing, price is rising. This is where it becomes bearish. Volume is surging, so it's still remaining at that high range of volume. When you have these red candles, you don't want to see that. When you have these red candles, you want to see a massive drop in volume like we saw here. We did not see that until after the failure. So that would have given you your indicator to get out. So entry, profit, hold, you're above the short term, and then you start to see the volume start to come in as price is falling. That means most people are selling off, they're taking profit from their initial positions. So another thing that I would look for when I was trading this setup is you want to have multi-time frames on your screen or on your multiple monitors. You want to be looking at different time frames and getting the overall outlook of the market on each of them. So I would typically trade a 1 minute or a 5 minute as my trigger chart. When I say trigger chart, that would be the chart that it gave me the signal to trade or not trade. So my other charts confirmed my position. So if I was looking at like a 4 hour or a daily, those are the charts that would tell me, okay, I want to take a long here. But where would I take the long? Because I'm scalping and I'm only trading for like a 5 to 10 minute move, I would use a 1 minute or a 5 minute as the chart that's like, okay, trade right now, take that trade. So I would look at a 1 minute to a 5 minute as my trigger. I want to see like a midterm for confirmation. So anywhere from a 1 hour, 2 hour, 4 hour, somewhere in that range, that is my midterm. And then for my long term, I would look at a daily. I never went higher than a daily because it didn't really matter for me to go higher than a daily. I didn't really care what these stocks were doing past their daily chart because I was just scalping them. So as long as I saw a daily bullish pattern like we do here, you can see here we have an uptrend forming on the daily. You can see that we have ascending highs. This is like an upward channel. So as long as I saw a bullish pattern, it's above both of the moving averages. The moving averages are in the right order. The short term is above the long term. This is confirmation that this would be a good setup to scalp. My midterm, same thing. My short term is above my long term. The volume is looking really good. It's above relative. And then my trigger chart, same thing. Short term above the long term. Volume's looking really good. So yeah, this is the perfect setup. And we could look at this on different markets, different coins, different penny stocks, whatever you want to look at. The setup is still the same. And like I stated in the beginning, you don't have to use the exact moving averages that I use. I typically use a 12 and a 72. As long as they're relative to, like I was saying, a short term should be anywhere from like an 8 to like a 15. Your midterm should be anywhere from like a 15 to a 30. And then your long term should be anywhere from like a 50 to 100. As long as they're relative to that range, you can use it for your own trading style. The ones that I found that worked the best were actually not these ones. I used an 8, a 22, and a 50. Nowadays, I prefer the 12 and the 72. The reason I moved to the 12 and the 72 is because I like trading the hourly chart as my main chart, and a 12 moving average is basically taking half the day of data, and the 72 is taking 3 days worth of data. But you can use whatever's best for you. And we can take a look at this on equities as well. This is crypto, so that was mana. We could take a look at equities. So if you're trading equities here, this would be a short setup. This would not be a long setup. You have your short-term moving average below your long-term. This one is giving you conflicting signals here because your short-term is above your long-term on your midterm, and then on your long-term, on the daily, your short-term is below your long-term. So it's giving you 2 out of 3 bearish signals. So I would still short this. Even though my midterm was not perfect, my midterm is not showing the proper moving average structure, you could still short this. So you would look for the same setups. You would look for breaks of levels, breaks of support, test of resistance. Since you're shorting, you want to see a test of resistance or a break of support, and you want to see the candlestick patterns to follow. And if you're shorting, you want to see increasing volume as price is falling, decreasing volume as price is consolidating to the upside. So what we saw here, we saw increasing volume. You see the massive surge on the daily, increasing volume as you have that candle breaking the range. Then you start to see consolidation and you have lower volume. Volume comes back in, failure. And now we're starting to see lower volume as price is rising. So this is still a bearish setup. That's why I would look to short this. So if you're scalping, this would be like scalping the ES, which is a futures contract. You would be looking to scalp very small moves. So typically probably around 2 to 4 ticks. Each tick would be worth $12.50 if you guys haven't traded futures before. So I would not short this just yet. I would look for a break in structure, a failure of this support here. You want to see the short term below the long term, and then you want to see increasing volume with like an engulfing candle or another bearish candlestick pattern. So like I said, you can use this on any market. You can use it on commodities if you trade like gold or silver or what are some other commodities like oil. You can use it on equities if you're trading futures like the NASDAQ, the E-mini S&P 500. You could trade it on the Russell You could use it on altcoins, which I used to do back before I started using all my indicators. Um, this is my trading strategy in like the first 2 years that I was trading. Um, and there are pros and cons to this. So like every other trading setup, trading plan, you're going to have pros and cons. The pros of trading a naked style like this is you're not getting a lot of noise. So if you have like a ton of indicators, like if you're using MACD, RSI, CCI, MFI, just all kinds of these indicators, if you're using a ton of indicators, the con of that is you're getting a lot of noise. And that noise is going to conflict. So some of them might be giving you buy signals, some of them might be giving you sell signals. You're not, it's going to be very rare that they're all going to give you the same signal. And even if they all give you the same signal, maybe the price action is not going to be giving you the same signal. So you're going to be like, okay, I really want to short this, but all my indicators are telling me to go long. And then you're not going to trade because you're completely conflicted. That's a massive con of using a lot of indicators. That's a pro of this setup. A pro of this setup is you don't have a lot of noise. You're using moving averages, you're using price action, you're using volume. That's it. If you want to throw in like an oscillator, like one oscillator, pick one. If you want to use like MACD or RSI or CCI, choose one oscillator. Don't pick 3, 4, 5 oscillators. The con of this setup is you don't have that support. So if you're trading with a bunch of indicators and you've mastered that trading style, it's because you've learned to read through the noise and look to where they support you. Where do their signals support your trade plan? And where do they conflict? You've learned how to read that. So once you've mastered using a bunch of indicators, that becomes a pro. The noise factor becomes a pro because you've learned to see through the noise and you can see the benefit of having all these indicators on your chart. When you're naked trading like this, there is no support. If you don't know how to trade price action, you are not going to succeed at trading naked with little to no indicators. But the con in that is you will learn how to trade price action. And I think trading price action is the most important thing in trading because it is the same or damn near the same in every market. Price action, and when I say price action, I'm talking about market structure, candlestick patterns, trend structure, stuff like that. So like higher highs, higher lows, lower highs, lower lows. Like I was just saying, increasing volume when price is rising, decreasing volume when price is falling, stuff like that. That's basic price action trading. When you trade naked, you are going to learn how to trade like that. Or if you don't learn, you're going to fail. So you're going to continue to fail, or you're going to learn how to succeed by learning how to trade price action. And if you're so for me, I started out in equities. I learned how to trade price action before I even touched indicators. I never touched an RSI. I never touched a MACD, any of that stuff, until I understood how to read candlesticks. Once I understood how to read candlesticks, I started learning how to read market structure. So when you're looking at like trends, you're looking at support and resistance, you're looking at highs and lows, so like double tops, double bottoms, stuff like that. You're going to learn how to read that on a chart before you want to start going to RSI or CCI or MACD. And I've said this many times to my viewers, people on Discord, really anybody I've talked to about trading. If you don't know how to read price action, if you don't know how to read candlestick patterns, you really shouldn't be using all these indicators. I know a lot of traders on YouTube and a lot of traders just out there on Twitter or anything, they love talking about indicators before they even teach you how to trade just basic price action. And for example, if you're looking at an RSI, So many people, they use RSI religiously. They love the overbought, oversold nature of RSI, but they don't understand price action. So as soon as they see, and let me pull up RSI so you guys know what I'm talking about. As soon as they see RSI in a overbought position, so anything above 80, or some people even use 70, they'll immediately sell because they don't understand how to look for reversal patterns in candlesticks. The problem with RSI is for something to be technically overbought, it has to be going up rapidly and it has to be going up very strongly. It can be overbought for a very long period of time. So if you sold as soon as it said it was overbought, you're missing out on most of the price action of that breakout. Let me see if I can find an example here. There is no example on the short term. Let's look at a longer term. So here we go. Here's an example here. So this gives you an overbought signal right here at 80. So you would have sold as soon as this was overbought. If you didn't know price action, you would have sold immediately. And you would have missed out on almost a 3% move on this move up, which is massive when we're talking about equities like this at the S&P. You would have missed out on a 3% move because you would have sold immediately when it said it was overbought. Instead, what you're supposed to do is you're supposed to look for, okay, it's telling me it's overbought. Now I need to wait and look for a reversal pattern. I need to look for that dark cloud cover, gravestone, hanging man, whatever. Any bearish candlestick pattern that you like to trade, that you understand how to trade, you look for those setups when it's overbought. If it gives you that trade setup when it's overbought, that's when you sell. You don't sell immediately when it hits that oversold or overbought point on the RSI. So what I'm getting at is you need to understand how to trade price action before you go into using indicators because they're supposed to be used together. You're not supposed to just say, okay, the RSI is overbought, I'm selling. Okay, the RSI is oversold, I'm buying. You're supposed to be, okay, the RSI is overbought. Let's look for a reversal pattern in the price action. Let's look for a double top. Let's look for a failure at a resistance point. Then we sell it. People don't learn how to do that because they don't trade like this in the beginning. You need to learn how to trade like this before you start to use indicators. And if you want to jump right into indicators, you need to understand what I just said. You need to understand that they are not a one-all, be-all, buy here, sell here tool. They are supposed to help price action. They're based off price action. Every indicator is getting its data from price action. So why wouldn't you want to learn how to read the data without it reading it for you? So just a quick recap. I'll go back before we end this little segment. If you want to learn how to read price action the way that I did, when I first started trading, all I did was this: moving averages, volume, price. Put on a few moving averages onto your chart. Like I said, a short term should be anywhere from like an 8 to a 12 to a 15. Nothing higher than like a 15. It can be a moving average, a standard moving average, or a exponential moving average. Doesn't really matter. Your midterm should be anywhere from 15 to 30. Like, same thing, doesn't matter if it's a standard or exponential. And then your long term should be anywhere from like a 50 to 100. You want them to be in bullish pattern, in a bullish setup. Short term, mid-term, long term. That's if you're taking longs. If you're taking shorts, you want it to be long term, mid-term, short term. You want to see, if you're in a long, if you're looking for a buy, you want to see increasing volume as price is rising. You want to see decreasing volume as price is consolidating and price is falling. If you're in a short or you want price to go down, you want to see increasing volume as price is falling, and you want to see decreasing volume as price is rising or price is consolidating. This is actually coming in at a perfect time because this is happening because you saw increasing volume on the way down, decreasing volume on the move up, and then you see a double top. So if you did what I was just telling you, if you look for that price action and volume, you would not have bought that because your volume is decreasing as your price is rising. You want to use multiple time frames to confirm your setups. So you want to have a trigger chart. The trigger chart is the chart that is the final chart that you look at to take the trade or not take the trade. My trigger chart is usually a short-term chart because I use it for scalping. So it's usually like a 5-minute. And then my supporting charts are longer than your trigger chart. So if your trigger chart is an hour, you want your supporting charts to be a 4-hour and like a daily. You want them to be longer. You want to have supporting charts that span much longer time than your trigger chart. So if my trigger chart's a 5-minute, I typically use a 1 hour to a 4 hour as my midterm chart. And then I use the daily. You always want to look at the daily. The daily is one of the strongest charts in trading. You want to see bullish patterns on the daily if you're going to be taking longs or if you're going to be buying. You want to see bearish patterns on the daily if you're going to be taking shorts and you're going to be selling. And you want to see the structure of the moving averages like we discussed. Short term, mid-term, long-term, in that order for a bullish setup. If you have all of that, you should take your trades when you see proper buy candles. So you need to understand candlestick patterns. When you see proper buy candles that are breaking resistance, that are engulfing previous candles, that are giving you the 3 candlestick bullish patterns like morning stars or dragonflies. And on those buy candles, you want to see a surge in volume. If it's not a surge in volume, you want to see it have high relative volume. For example, this candle here. This candle broke resistance, surge in volume. That is a candle that you would have bought on. You would not have bought up here. You would have bought down here. If you missed the buy, you would have waited for a pullback. And you want the pullbacks of breakouts to be above your short-term moving average. So if you're using like an 8, it should be above the 8. It should not be closing below the 8. If you're using like a 10, same thing. 12, whatever. So long story short, use price action before you go into using indicators. Learn candlestick patterns. If you guys need some books to learn candlesticks, if you guys don't know how to read candlesticks, the books that I recommend are Getting Started in Candlestick Charting by Tina Logan. A very short book. I think it's like 250 pages. Very, very good to give you a very basic understanding of how to read candles and how to read trends and how to read reversals. Another book or another series of books are the books by Steve Neeson. He has, I think, 2 or 3 books on reading candlesticks. They're all very good. You can find them online for free, or you can buy the paperbacks. They're not very expensive. I think you can find them on Amazon for like less than $20. Once you guys understand candlesticks, then you can start to grasp how to use indicators because that's where they're getting their data from. But that is it, guys. I want to clarify that this is not how I trade right now. I do use this, obviously, all of this in my in my thinking process, this is how I initially learned how to trade. I trade now using indicators and a bunch of other things, but this is how you should really start to trade in the beginning. But that's it, guys.